is being recorded.
Johnny,
What's up, bro?
yeah, can I request you out? Thank you. Also, the AI companion. I found the Zoom AI companion other AI.
So you ready to tell us all how to raise never raise no money?
Yeah.
That's my final question for you.
I
If
mean,
somebody was getting started today and they wanted to raise $1 million, what would you do?
So
Don't answer it. Don't answer it.
we can buy a gun which is $500 and then rob a bank.
There you go. In their vaults. You
Yeah. Let's wait for
okay.
yeah.
Cool.
For the list we are already back, right?
Yeah, it works. The one guy I talked to today, he was in the hospital. He didn't even realize his property was on the docket, and he said that his daughters live. Oh, I'm gonna.
Yeah. I mean, these are highly motivated people. So this thing, it's I think it's a great way for us to work together because I'm not good at cold call. I'm not good at talking about, but I'm really good at numbers, all the stuff. So, I mean, after last week's meeting, I made another thing too. But also, I think the big one is I bought a over $500,000 house, which I probably will make $250K from that. So
Got it.
yeah,
Are you gonna That's not you're gonna put money into it?
no, these are I already put $250K there. I mean, the problem with the foreclosure is you need to have cash immediately. Like you need to pay 4 hours. No exception. Yeah.
All right. Do you have slideshows then?
Actually, I didn't. I mean, we just talked about this afternoon, like maybe a few hours ago. We need to talk today. So, but I can promise I talk slow, and then we should, when we edit the video, we should be able to add some content. This is like talk. Yeah, it's not that difficult. It's kind of like if anyone wants to do the thing, there's no.
Yeah. Randy, what's up, brother?
What's going on, guys?
Oh, and Randy's my partner. We do pre-foreclosures together. He's in
Awesome. Hi, Randy.
Yeah,
Meet you. I do foreclosure too. Pre-foreclosure.
awesome. Small world, right? I mean, those are good leads to go after.
Yeah.
Randy's helping me hit up those Chicago leads too, so you can call. Two, our guy from LA. Let's go, bro.
Oh,
got a full house.
Hey, Sonia. I think we had it at that place that we all went with, where they had the bull riding thing. You're muted. All right.
And there we go. There we go.
Yeah.
Sorry about that.
All good.
Good.
yeah, and we start.
I was just getting ready to say that. It's been on the feed all day.
Oh.
Yeah. Yep. In Haddonfield, South Jersey.
What I do well, county is that? Cumberland?
Camden.
Camden, oh, but
Okay.
why
Well,
not out there?
We got a little, it's in Haddonfield, a bougie town, and it's like a little condo. I'm like trying to get the comps right. It's like 300 and some foot. It's crazy. 902.
Yeah.
Let me So for tonight, to be capital raising, Owen's gonna go over a couple things, but yeah. So take it away, Owen.
Yeah. Can you hear me clearly?
Yep, loud and clear.
Yeah. Thank you, Tony, for organizing these activities. We have been talked a lot in the past few months about multifamily, different sectors, how to do these deals, about foreclosures. I think we have 5 recorded Zoom meetings that we probably in the future. So many of us may be familiar with family domain. The way we do the multifamily or big commercial deals will more or less similar, but in a larger scale. So specific multifamilies, like say like 100 units, right? It's sometimes I feel that it's actually a little bit easier to do 100 units multifamily than single family fix and flip. Because I have been, I mean, there's something hiccup yielding calculation, like the base, managing the contracts, a lot of headache when lots of bad apples in those domains. In multifamily case, like especially in big multifamily communities, the benefit of us is we manage the people on site. The reason why we use big scale is we wanted the units to be enough. So say like we have 2 or 3 people working on, one is like leasing, one is in maintenance. We pay them for benefit, right? So in that case, if we have 100 units or above, the average cost adding to per unit will be roughly $1,200 to $1,500 per human salary benefit. If we have units less than 100, the amount of the payment won't be much less, which means when you add it to unit, the cost can be 2,000, 3,000 a unit. If you have 40 units and then you put like 2 people on site, because it's very rare to find a guy who can do the leasing and also do the maintenance well. It's very difficult. So you need to separate these functions. So that's actually one of the main reasons why we want a bigger multifamily deal. Can't do it. But obviously, like how to get there? Like it's not like one step. It's always the step by step building up the. Then every time you move a little ahead, takes time. So hey Dana, can you mute? Yeah. So then in multifamily, then how do you do it? Usually in single family case, like many of us start from like we do everything to the house hack, and then to have the capital either from or like borrow from our friends. Like we do everything. In multi space, kind of like divided those jobs into 3 sectors. Finding deals, due diligence, have the honest money ready, find how do you say, coordinate with honest agent, find a third party management company, all those types. The second part will be after we get the deal under contract, we need to do due diligence, we need to have honest money, then it's time to raise capital. Capital raising is a big portion of big multifamily deals. Actually, it's probably the most important one. If you have money, you can do it. You cannot do it. So, capital, it's not something that everyone can be ready to do that, but everyone can pay attention in this space and gradually grow your influence, grow your trust among your social network. And a step, sooner or later, you'll get something. The third portion will be management part. which will be like deal with the local people, managing the third-party property management company, managing the local state activities, like about how to improve the occupancy. That goes to marketing. Whether you go to apartments.com, apartment 24/7, how many leads that can generate that. And then local people need to follow up by phone call, convince them to have like on-site visit. And then after that, what's the ratio that you can promote those leads into leads? That's just one aspect of the management part. You need to stay on top of that. If you lose, things can go south quick. Part will be capital expense. Say 60 days, 90 days, how many leases need to be renewed? What's the rate? If the tenants stay here, you raise $30, $50, $100, really depending on far away that's to the market rental. And how many vacant units you in the whole complex. If you have very few units vacant, you really want to raise the rent up enough so that you have enough vacant units that you can do the rehab and improve the rent. The vacancy rate is, is too much. You need to slow down the hike. This is an art, not science. You need to play around by a few times. You more or less you see, like if there's lease need to be renewed, to be like 50% remain, 50% to be pushed out. It depends on the factors, right? Then you need to decide. After the unit is vacant, you need to decide what's the capital expense, what's the rehab package. Say you do no plank flooring. Most of the time now it's a vinyl plank, but about the countertop, Formica, you do quartz. About the appliance, you do stainless steel, black or white. So every piece has some price depending on what's the rent premium you can. You always need to do the calculation of the what's the extra budget. Say like stainless steel, I need to spend $2,000, but then raise the rent by $50. You need to do the calculation. If it's yes, then it may be worth it. If not, then you need to think about, oh, I may not need to spend this $2,000 extra. Same thing about the quartz or Formica. It also depending on whether the unit is in class C, class B, or class A condition, right? So if it's really in class A location, you really want to make these units very nice, have smart light fixtures, smart audio, all those type, like security camera, right? But you class D probably, then forget it. I mean, you recoup the investment. So all these decision making, you need to have experience in order to know which to go. And then part will be maintenance part, right? What every week there's like a what went wrong. So by monitoring this, you will have rough idea, whether the whole community will have big trouble down the road. Like if you keep see like, oh, there leaks on the floor, then you will know you must change the roof. Changing roof, it's probably the one of the biggest capital expense. Changing the roof, the HVAC replacement, the plumbing, the electrical, these are ones. Other ones I call like lipstick. If you just need to like painting, you need to change the light fixture. These are easier. So overall, these are the asset management contents where we need to have experience in order to manage those well. So in multifamily, again, we have deal sourcing, we have fundraising, you have asset management. Those three, I call it three supporting the acquisition, the finance, the whole operation of multifamily domain. So people can have rough idea of sector, what we need to do, and what's the function of how that relate to the success of the whole project. Talk about, buy right, finding good deals, finance right. Finance right is like in the capital raising and what kind of loan structure you can have. And so there are more details about each right. For example, like in the next 12 months to 18 months, I really think there's golden opportunity for a reason. Before we go to capital raise, let's pick this. This is the big picture. I want everyone have a good idea of they are allocated, right? So during the pandemic, like everyone knows that interest rate is really low. So even commercial 3.5%, there are many people, I call them hackless, like they will do like 3-year interest only loan. The reason why they do that is if you do a 10-year fixed rate, the interest rate can be say like 3.85. But if you do 3-year interest only loan, the rate can be 3.5%. So they try to get that 0.25% point, but fix the interest rate for 3 years. This year is 2025. That happened in 2021, 2022. 3 years time lapse is the time for them to renew the mortgage. And now usually the renewal interest rate will be the prime rate plus 3 point something like that. So now the interest will immediately jump from percent to like 9%. That caused two problems. One is, say originally you pay 40 grand. Now you need to pay 90 grand. Sometimes they even kick off the principal pay down grand to 1 or more. I'm sure every property, the rent will increase in the past 3 years, raise 20%. But that rent increase is then the interest rate hike. So that causes problems. Say, if you cannot pay the new rate, what can you do? You refinance, or if you try to sell before, say like Class C property, the capital rate probably is 5%. Now it goes to 7%. The value decreased by 5% to 30% by the rate hike due to the interest rate hike. So if you need to sell the property, your investors' equity will be wiped out. So let's go to refinance. Again, if the property originally was $10 million, people pay $3 million down, have $7 million mortgage. That's very common, right? Or sometimes it's aggressive, is even have like 80%, 85% loan to value, which means they have $8 million mortgage. And then now the interest rate was high. When you apply for the commercial loan, they need to fit a few criteria. One is called a DSCR, which debt service ratio. Means that you have income, you have all the expense, you get rid of that operating income. And DSCR means the mortgage expense versus the net operating income. it needs to be above 1.25, 1.3%. Like you have NOI of 40 grand, which means your mortgage payment can at most go to 40 grand divided by 1.25, or sometimes it can be 1.4, depending on how conservative the banks. Which means you can only have 30 grand mortgage payment, which will limit the amount of loan you can borrow. All these are like chain reactions going back. So originally you have $8 million loan. Now you can at most mortgage it out, say like 6 million. So there's a gap where that money can come from, which means they need to have capital call, means for all the investors, whoever invests in this project, say originally you invest 100 grand in this deal. Oh, because of this, because of that, now another 100 grand into the deal. That causes big problem for the operator, for the whole project. And now is the situation. It happens now. So the reason I know that is I kind of like every day I got calls from like brokers from their deals. Are here, are you interested there? During pandemic, it's very rare for you to get any call from brokers because it's the buyer's market. It's the seller's market. You know, you need to these brokers. Now it's opposite. So that's where I know that there are lots of deals, you know, underwater now. As buyers now, I think it's a golden opportunity for us to find these distressed, mismanaged properties. We can do easy fix up. In 3 to 4 years, investors really double the opportunity now. So again, these are like the overall picture in the commercial domain. It's a little bit different than in the residential part because residential part, you know, interest rate majority will have in very low interest. So when it's in this high interest rate environment, people just don't want to sell, which drive up the supply. If the supply is limited, you know, supply demand curve, you know, skewed. Keep single family residential space price going up and up because supply is limited. In commercial, it's because it's all cash flow talks. It's all like interest rate have impact there. So that's where like and as a buyer, you know, pick. So these are like a general scope of market, all the commercial real estate space. Again, buy right, find a good deals, distressed, mismanage it. We do value add improvement. Finance well. For me, I'm very conservative. We don't do like 3-year interest only. Like the minimum like loan we demand is at least 5 years. Most of our loans are 7 years, 10 years, or even 30 years fixed rate. So whenever there's market turbulence, we can ride the wave. So going to finance right means this mortgage is right, and then we will go to capital raising part. And the third part will be asset management. Again, that also demands lots of experience in this stuff. So today we are focused about the capital raising. So how can we do that? How like an ordinary job, right? I came to the US with debt. So my argument is that everyone can do it. I so far in like $30 million capital for funding all kinds of my deals. But the dollar is not like one day, one night thing. It's like several years, counting the seeds, care for that, wait for that. The reason for me to be relatively good in this space is it's my track record. It's my way of, I'm very open to my investors. I'm very open generally to share my, you know, expertise, share my lessons in those space. it didn't grow family space itself. It started from a single family domain. When I was doing single family fix and flips, doing foreclosures, again, like for foreclosures, we need cash. Like you buy something today, you need to pay off tomorrow. See, the one I just bought a few days ago, it's like $557,000. So I need to have cash in the bank before I can bid for that, because otherwise, to pay off that, right? So, but that does not scale. I start from like $32,000. Both foreclosure deal, I bought that way, which I can borrow from finance that, by the way. So, the way it works is, I paid first deal $32,000. I rented out for $950 for almost 3 years, and then I sold that to the tenant who lived there for $110 grand. That good, maybe like 3x in 3 years, 3 or 4x, because the rent already recouped all the investment. So, but then second deal, third deal, I bought all those first 4 or 5 deals, all using my own capital, right? But the problem again is that it's very capital intensive. After the fifth or sixth deal, I don't have cash anymore. What can I do? By then, actually, I had a full-time job, work from home, work remotely, but I went to Chicago downtown. There's an office, my previous company. I went there from time to time, just hang out with people, right? So usually we have like from lunch out. Like, there are so many like white collar people working in downtown Chicago. So we go out, have a chat, who's doing what. So one day I just said, "Oh, I'm doing this deal." By the time I said I bought this. I mean, if you check them, it's at least 100K by that time, right? I bought like 70% discount, and I didn't do anything. I rented out for like $900. Then that actually inspired people. Oh, I have 50 grand. Oh, the other guy said, I have 100 grand. If you have 5 deals, like just, we can invest deals together. That's the way I start my family. The first deal is like 50 grand, right? We have 100 grand. So within 3 or 4 years, I think by that time I expanded my portfolio crazy. In 2019, I think I did 5 deals a year. And then after pandemic hit, slow down, and then I go back to see like what did that. For the fundraising part, I'm using like $5 million of other people's money. $5 million. It was space in 3-4 years. But then going back to see like how I attracted $5 million in 3 or 4 years. It partly from my personality. I need to share. The more we can get in a return. I mean, that's my firm belief. So we share. We not only share our like roses, but all the challenges, difficult part, going through different deals. This way, actually, it the trust to other people. Oh, it's nothing is very like to, and I did lots of challenges. I mean, the good part for my beginning journey is I'm doing foreclosures. So I already have 30%, 50% embedded profit margin there. So I can a few of the fumbles. So luckily that, but even for those embedded profit there, when a pandemic came, I'm quite scared. I'm not scared in a way that I have great financial pressure. I need to move this around, because remember I bought in cash. I do not have that, but I do have pressure that when can I turn around this property? I can sell, because everything was frozen. Everyone worked from home. and nobody wants to come out to meet with other people. And by that time, I really didn't know how long that situation will last and what's the impact to the real estate market. I have no idea. I did have feeling that the property value actually dipped 5 to 10% when the pandemic hit, when there's executive order like a work from home for the whole country. Actually, by that time, I liquidated maybe 10 properties. And when I go back to what's the, I think the expected, I didn't reach my expected. Personally, I didn't lose any money. In properties which just turn around slower, I returned back dollar to my biggest investor. Like she's looking for money for whole other business. By that time, different people are stressed, and she had a business run. Like her money was stuck in my deal, and my deal was not originally it can flow like 4 months to 8 months, but when pandemic hit, couldn't promise how to do that. So, but she needs the money to make her business a very challenging period. And later on, I said, okay, my bank account has this money. Gradually, my bank account has 200K. Can I return back to you? I couldn't expect you any return, but I'm willing to, buy you up this 200K. Next time I sold another property, I said, oh, I have another 200K. Buy her out for this project. Actually, I buy her out for $1 million. Like she got no return. I don't have more stress from investors. By that way, this way, we are acting honestly. We are acting in the interest of our investors, and this way is the way trust gradually. So when pandemic came, then I need to think about, what can I do? Because everything was like back down, right? So that's the way, like, I felt, the life was miserable for me when I was doing like trips a year. By that time, I have like 65, 70 units in hand. And my time was very limited. This property here, that property there, every time, like every day I'm like on the phone call for like 40, 50 times. Text 30, 50. Like it's very strict period. And my job at that time. So the first decision is I quit my full-time job. That saved me a little bit of time. But then the lifestyle is not really what I want, because irritated, like these things I really enjoy that. So I need to shift. I started to do multifamily. By the way, for that I already started as a passive investor to invest in other people's multifamily, new construction, hotel, daycare, storage, all those type. So I kind of have some sense about each sector. We're all working bad, how they are working, because we got like month or quarter report. And if I have questions, I talk. So some sense about that. That's where I naturally to multifamily, because the biggest unit by that time I did was like 80 units in Chicago. And then I need to move to multifamily. And the first deal I bought was like 64 units. But 64 units, like we didn't raise capital for that. We for 800K finance. And I mean, our track record is still there. Then when I move up to like 140 units, 133 units, 233, all those type of apps. The first big raise was like a little bit over $3 million. I already have like 50 investors behind me, right? And not only by the friends or investors, mouse by and then I started to do a little bit of social media. like WeChat platform, which is WeChat group has like I have like over 1,000 people in that group. So we came together, we share information, all kinds of investment, say rental, whatever. The reason why I created that group is so many people ask me similar questions. And I just feel that, by drag everyone into the group, if anyone asks one question, else can answer that. That's a good way to communicate. From there, I started to do a little bit of my YouTube channel. That group is private. YouTube channel is public. So from I'm just sharing my journey, my experience, my fix and flip, all those stuff, right? But gradually, I can feel that propagate much faster than the neighborhood, mouse by mouse, friends by friend. Actually, that to a Pace Morbius group. I want to know how he did so to, and that's the way like I raised the capital from 5 million to 30 staff. And now this year, actually, my focus will be my social media because I talked with Johnny, I talked with Water, lots of other people. Like I can feel that I'm doing multifamily. I'm also still doing the single foreclosures, pre-foreclosures, tax liens. Every piece of these areas actually will be very important to many people, especially to Pace Morbius sub-2 group. I feel like people who are very energetic, who want to find opportunities, but do not necessarily have lots of funds available, but are willing to hustle to work hard. So, last week, like Johnny and I I made 10 grand in 1 hour. I should do another Zoom like 30 minutes. That's a tax link. So, but usually tax link has redemption period. For those tax link means that the homeowner does not have pay tax. So only the city can sell the tax owned by the property. And usually what happens is that also need to go to a say like if you own $10,000 tax, people bid on this $10,000. The way they bid the tax lien is, first we $1,000 with 18% interest. The second bidder said, I bid 10 grand with 15% interest. The third one will, I bid with 9%. With sometimes you can that amount with because most likely these properties will be vacant. The bidder will wish owner can forget to pay the tax within the redemption time. They do not redeem the tax lien, and then the tax lien holder fought to get the deed. You pay 10 grand, 20 grand, you may get a house worth 300 grand. That's where people are willing to bid with 0% interest. I had a exact example for that. I can show people sometime down the road. But usually tax lien is that you bid 10 grand for that lien, right? But you cannot do anything because there's a redemption period. Some area has 6 months redemption period. Some area has 1 year. In Chicago, we have 2 years redemption period. And in pandemic period, we add extra time. So sometimes there's a 3 years, which means people need to be aware of like a redemption period. For me, because my focus is on multifamily, other commercial real estate fundraising, I go to meet different kind of people. I'm looking for deals. I only spend like 10%, 15% time on my foreclosures, single family, smaller deals, right? So I have this in tax lien because with that redemption period of 2 years, it gave me too much uncertain. I didn't know, like my capital will be serious. Like I really didn't like it. Another opportunity, like there's tax lien which already get over the redemption period. That mature tax lien. So the property I got is like I got that property with $5,000, buy that mature tax lien. And I think the ARV after repair value will go to 150, 160. It's a townhouse. It's actually reasonable condition. The problem is that I'm kind of like, I'm not in this space anymore. It's not exactly how to go because I just feel I don't belong there. A funny part is that the other day I stopped by there with my buyer. I actually assigned you to his friend for half an hour, but I did visit there with him. Immediately after I stopped there, I mean, I'm stopped. Are you what? So there's stuff like this in different communities, right? That's where like my buyer, he's that race and he grew up like that community and he's very happy. Like I signed this deal to his 65K because he probably make like 50 grand out of it. But for me, like this information, I know the buyer can make, I just do a markup. So 5 minutes make 10 grand. It's a good deal for me. So, but for majority of people in sub 2 in this group, it's still a good market to do that. It's different than cold wholesaling. I absolutely I couldn't do the cold call. These days, there's opportunities by foreclosure of space being along there's different opportunities. Again, going back to fundraising part. So it's not like a one night, one big leap. I can get like 1 million, $10 million. It's starting from like 50K, friends, family members. After we build up the track record, we gradually grow up our circle. We raised more, but obviously we need to take care of the investors. After this moment, my pressure will always be taking care of the investors' money. That's the biggest pressure. So that's where like we were very picky about projects. We want to make sure that well, and we take less risk. Like try to think about what we have long risk. If there's hurricane, how can you deal with that? Do we have enough reserve? That one actually we talked in Germany is one of that. We need to have enough reserves. Do we have enough backup people to take care of those properties? All these, every process flow, like do we have backup plan? So we went through all these processes. We feel more confident about, carrying out these projects better, deliver, exceeding the expectations. These are like the positive loop. So that's where like, I'm actually pretty confident I can raise more money now. And that's the main reason why I joined the Pace Morbius, the owners club, along his way to do social media. Obviously, my experience than Pace, I have a lot more different than him. He's more in sub 2 in the wholesale space, but mine is in foreclosures, pre-foreclosures, single family, going to small family, multi-family, big multi-family, self-storage, land development. I kind of feel that I can offer a 4-step, small and a big, and how can step by step doing these deals, risk but be cautious every time. And the way is that after I can do my social media with YouTube, Instagram, more in public space, I really feel that I probably can raise capital by 10x. Like That's my feeling. I mean, we will see in few years. But if we get from like $3 million to $300 million equity, then we can do like $1 billion assets. Scale economy will play. That's where like I always want to didn't charge much upfront. In the commercial space, actually, I mean, the other day, I mean, my friend, consulted with me whether she another people's deal. I kind of peel off the hidden charge of that way, 0.75% upfront from your money. They charge at when exit. So if you invest $1 million, he will cut 5.57,500 in the beginning. That's not the type of deal I want to, not the type of deal that people I want to associate. But in this commercial domain, there are lots of people who act like that. Be careful. So hopefully, my journey, my experience can give people some hint, some motivation, some thank you.
Good stuff, Owen. For the new people that are getting started, right? So fast because we got to wrap this up. If there's anyone that has any questions, but like if I wanted to raise, it sounds like credibility, trust, net. Sounds like you a lot of your fun by networking with local people in your area. So that's why they always say your net worth. How about like what are like if you're gonna like structure a deal and present it to or what are like things like that, and has any questions that they're curious about, to the floor.
Okay, the question is, if we want to do a deal, how can we structure the profit sharing investors? So different people, different budget are different, I can say, but I can just give you an overview of that. In GP-LP syndication structure, the LP will take certain percentage, P will take percentage. But like for me, I usually do like very simple 20-80 split. The capital invest return, GP team got 20%. That's the simple way. Other people may charge 30%, 70%, or even 40%, 60%. I charge 20%. Another way, waterfall, which means, say, first 6% to 8% will go to the investors. And anything above 8%, GP will charge, say, 35%, LP charge 65%. That's called a waterfall. These are pretty common structures. What I want to remind investors is, what are the upfront charge the GP team can charge? Sometimes these can be very expensive. Like the example I mentioned, upfront charge 5.75%. That actually will motivate the GP only to do deals. As long as they can get deals, they get very good paid upfront. That's not good for align the GP.
Cool.
Barbara has a, do you do any venture capital investing? Venture capital, I do money lending. Is that venture? Okay, let's generally talking about venture capital versus private equity, more like a funding like state. It more or less defined upside, but it also has defined risk. Venture capital is more or less like you take a bet, the upside can be bigger, but probably like 80% can be down to zero. That's where like we call it VC investing in startups. That's where survival rate will be like 5% to 10%, 80 to 90% of money. But if you bet right, like Facebook, like Twitter, like Tesla, and X, so.
The healthcare software.
Yeah, Barbara, did I?
Oh.
Yeah.
Yeah, this deal came across my desk, which is a healthcare software. It's looking for 1.5 raise thousand per share.
I usually don't do that because I don't have expertise to evaluate the risk. I mean, I've been doing a big difference between real estate investment versus VC is real estate is more or less define a return, define a risk, which like when you like use code, it's like real estate is this very smooth. VC is like this. Like I don't so my future plan say like down the road if I have enough money, real estate is very heavy. Okay, extra money I couldn't invest in real estate. I will probably invest in big tech like EDL, like QQQ, like SPY type. So, but I don't VC part because one is, you know, when I have enough money, I'm getting old. I don't want to like monitor those. Like if I don't want to have high. Any other questions?
Yeah, I got a question. For your typical exit on any of these multi assets that you're buying, do you have a kind of projected timeline you want to exit after 7 years, or is it going to be based on some kind of market threshold? It needs to get to a cap rate of X, or what's that look like for you?
Yeah, that's a very good question. What's the exit strategy? What's the timeline? Usually we do project to 5 years. That after this moment, for us is we need to have enough cash flow to cushion the downside. And at the same time, we want to do value add for those multifamilies. Say like each unit has a potential of raising $200 to $400 rent per month. The reason why we do that is it's balancing the downside of risk, because if we have enough cash flow, we can cushion the bad market. Say like if there's 30% vacant, can you survive? We do the stress test. After pass the stress test, then we say, what's the upside value add portion? Usually cash flow, we are looking for 5% to 10%. Like the deal I closed, it's like over 10% cash on cash. That's extremely good deal. And the dollars per month, right? For each unit, you can usually with $1 increase, the value is equivalent to $200 value add. The reason is that you have $1 per month, you have $12 per year. This $12 per year extra revenue does not cost much, because think about that. When you raise this $1 or not, your fixed cost is there. You already have people managing their software, anything. The rent hike there will be your net profit. That net profit, $12 per year divided by 6% cap rate, which is $200 value creation. So if you do $200 a month, that's roughly equal to $40,000 value add. If you have 100 units, that will be $4 million value add. That's the calculation. Usually these process happen in the first 24 months, because after we pick up, we try to start to improve gradually, one by one. At most 30 months, it will be finished. So then you think about push the rent to market value. What extra we can do? We can only adjust the rent according to the market fluctuation, according to the inflation. So which means after 3 years, the value add portion is significantly diminished. That's the time we need to think about exit, because the first 3 years we created the most value for all the investors. But the real estate, the big commercial real estate, takes time to sell. At least 6 months, most likely 1 year, 18 months time frame. So by that time, obviously, we need to think about, what's the macro condition, like Fed interest rate, all those type play around. So that hookup total will be about 5 years. And after this, people may say like, oh, you still generate enough cash flow. Why you sell? Is in the first 3-4 years, we 25-30% return for investors. When you keep it, you can only get like 10% return. So you can sell it, do T1 exchange to buy another property, which can generate another 25-30% return in the beginning. So hopefully that.
All right. Well, for next week, we'll have a new topic. Any thoughts?
If anyone have topic want to talk, again, like I do from like single family to foreclosures, pre-foreclosures, tax liens, big multi-family to self to land development. And also can I evaluate my partners, because if I really need some help, I need to form partners with other deals. How can we screen out people? The relationship build up. I have been, a lot of times, so I probably can provide my perspective on this space. That's where actually I want to make content among all these space. So, and also I will real examples to show it looks like, so people have better feeling about that. So
Cool. I'm gonna put the screen on. Let's do a group picture.
yeah, that is awesome.
AI bots.
Who want to show no, someone else may to show their face. So
Yeah. If anyone wants to turn their camera on.
Yeah, whoever wants to, hey Dana, first walk.
Right, ready? 3, 2, 1.
Cool. Thank you. I'm here. This is my phone number. I'm actually building up my social media. I spoke a little bit about whether this channel versus this channel.
I told you you can take this video now, and I think it's called Caption. It's like $10 a month, and it'll translate from one to the other. So
Yeah.
that's what I would recommend personally. But yeah.
Oh, bad thing. I didn't record. You need to share the recording with me.
You didn't record. All right. See, yeah, this should convert afterwards.
Okay. Yeah.
Because mine said is recording, so
If I record it, I can use the AI companion. They will give me automatic summary, awesome summary. So that's good.
Yeah. All right. Cool. Thank you, Ellen. See everybody. Appreciate